So do you understand how lenders give you a loan in the first place? How do they decide that you qualify for $1 million loans? So the way they do it is through something called your debt to income ratio. They want to make sure that you alone, through your job, can afford this property. So they take this giant sheet and they take all of your monthly expenses, things that you have to pay for. So if you have any other like student loans, they'll take the minimum payment for that. Car loans, minimum payment for that. If you have a credit card bill that you don't pay off every month, they'll take the minimum payment for that as well. And they'll also add in the principal, interest, taxes, and insurance for the property you're gonna buy. It's called your PITI. Okay, that's like the minimum you have to pay for the property no matter what. They add all this number up, plus any other PITIs for other properties you have, and put it at the very, very top. So this is your debt number. This is how much you have to pay no matter what. They take that and divide it by your gross income. So your gross income is your salary divided by 12. So before taxes. So if you made $120,000 a year, that's $10,000 a month. So they want this debt to income ratio to be between like 43% or 50%, depending on what loan you're getting. 43% is typical for most of the higher end homes like the Bay Area, okay? So to find out how much home you can actually afford, they'll take like that 43% number on the right, they'll multiply it by your gross income. That's gonna be some number here. Then you're gonna have your PITI number. They're gonna subtract other debts you have, like your car payments, and then it's gonna be your principal and interest payments here, and this other number right here. And then they're just gonna use a mortgage calculator to see, based on loan amount and this interest rate, you're gonna have this principal and interest like number you have to pay every month, and that's gonna be how much you can afford. It's just like a back-end calculation through that. They'll tell you like, okay, you can get a loan for up to $500,000, but if you back in a 20% down payment, then your total amount is gonna be like 600 something. So you can afford like a 600 something thousand dollar home, assuming that you're putting in 20% for your down payment. Then for the next month, that's about as long as it's gonna take to do the escrow process. Your lender's going to do a lot of paperwork for you. They're going to order an appraisal. A third-party appraiser is going to come by and check out the value of the property. They're going to make sure that you didn't overbid on this property too crazy. So if this property is only worth $500,000, but you went crazy and you offered $800,000, then the lender is not going to give you 80% of your $800,000. They're gonna be like, you're too crazy. We'll give you 80% of your $500,000 and you have to cover the difference. That's a really big deal. And it kills a lot of deals when like your appraisal comes in too low, because the buyer then has to decide, do I want to pony up another like $200,000 on my own cash to do this? That's kind of how they do it.